Hey everyone, welcome back to Red's Roundup. In this video, we're doing a value versus growth deep dive. What it means for you and your portfolio. Let's get right into it. Before we go on, I think it's important to think about why we look at value versus growth, why it's important to you and your portfolio. So I have a few reasons here listed. Value versus growth is mean reverting. So if you look at the value versus growth cycle throughout the centuries even, it's a mean reverting cycle. And it's important to know where you are in that cycle for you and your investments. Secondly, it's a good measure of whether or not growth or value is over or undervalued in the markets. And it's the easiest market indicator to look at relative to many other indicators that can be complex, vague, and hard to understand. So we're going to take a look at a few charts here. Starting out, this is the first chart. This is probably the most easy to grasp chart, and we're going to get a little bit more complex from here. So with this chart, what is this chart? This is growth versus value. As we see here with the description, a rising line or a high line indicates that growth is outperforming value. And when it's a low line, that means value is doing well. So as you can see from the past, for the past 10 years or so, growth has been absolutely killing it compared to value. We're reaching all-time highs in the value to growth index. And you can see that this mirrors one other time in history, recent history, that you might be thinking of that many investors are worried about right now, and that is the dot-com bubble. So we see it's pretty much the exact same rise that we saw then as we're seeing now. One other thing to keep in mind is what happened after that, is that value started to outperform and growth tanked from there. Growth really hit the tanks right after the dot-com bubble, and that looks similar to what's happening today. Maybe we're heading towards something similar, so that's why this is important. So let's look at, you saw there, that was the S&P 500. Those are large cap names. Now we're going to be looking at the Russell 2000 value to growth index and the difference there. Excuse me about that. So we see here starting 1998, we have the value versus growth. Again, like that other chart, this is pretty much the same chart. It peaks massively with the dot-com bubble where growth is way ahead of value, way outpacing itself, and then it falls down to earth very hard. That's the mean reversion we're talking about here. And we can see it hovers generally around the mean for a while. And then, now in 2020, it's absolutely spiked way up. So growth has been way overvalued in comparison to value as of right now. And I'd like to keep in mind, this isn't saying that all growth stocks are overvalued or all value stocks are undervalued. This is saying on average and as a collective, as a cohort, the individual groups are growth a little overvalued and value is very undervalued right now in the markets. And I don't know when that's going to change. Here's another graph that's going to help us make sense of what's actually going on in today's market and separate the two. So all the charts we've seen so far have had both value and growth compared against each other. Now we're going to see them independently. So this is the forward PE ratio for the S&P 500 growth in blue and the value in red. So this essentially means the forward 12 months of earnings, how much does that stock sell for compared to that amount of earnings? So we see in the blue, again, sound like a broken record here, but it's very important. Running up the dot-com bubble, growth's PE ratio had a massive expansion, and that accounted for much of why the prices for growth were so much higher than that of value. And you can see with value, it had a little bit of a rise, but in the end, it didn't really rise all that much. And when it fell back down to earth, it wasn't so much that it fell back down to earth as it just sort of glided there for a second, as in 10 years or so. So then after this, we see in the financial crisis, sorry about that, we see that value and growth's PE actually converted into one. So they crossed over each other, and that is very unusual for a crisis. So then after that, value, the PE ratio starts shooting way up. Before today, where the PE ratio actually peaked over 30 times forward earnings. And for growth, it hasn't even reached 20. So we can see a big difference in relative valuation of these two cohorts. And we know that many stocks in the growth are much higher than a 27 PE, and many stocks in the value are much lower than a 16 PE, and vice versa. So this is an interesting thing to keep in mind, that relatively speaking, historically speaking, growth is at a very high multiple, whereas value is at a pretty traditional multiple. It's selling for basically what it would be selling for in 2009 or 2016 or 2017, even for that matter. So growth is not as richly priced. Value is not as richly priced as growth as of right now. So let's take a look at this other chart that is going to really show the mean reversion again. We see this middle line here, that's the 50-50 split of growth versus value, and this is only from 1997. So keep that in mind. There's a long history that we're going to examine other than just this short time period of a little over 20 years. So we see here again, growth outperforms, but then value tanks, and vice versa. So we can see it always sort of rebounds to the mean. Occasionally, value will outperform, and if you bought value at its low and sold it at its peak, that's a big profit if you can do that, because value outperforms. So, and if you look at it today, you might be thinking, when am I going to look to get into value at the cheap price? Because if you can get in at the cheap price, that's the whole goal. Buy low, sell high. It sounds cliche, but it is very true. Be greedy when others are fearful. Many people right now are fearful of the value trade because they're seeking out massive growth. So they're afraid to get into here. Maybe that's where you step in and say, hey, I'm going to go after some of these value stocks, some of which I've profiled on the channel. I encourage you to go look at Ultria and Geo Group. Okay, so continuing, that's the mean reversion. We're going to see historical perspective of value versus growth over time starting in 1927. So this is going back almost 100 years. So as we can see here, growth and value neck and neck for a while, but as the century progresses, value takes a massive lead, and it's hard to see with this chart because it is a logarithmic chart that goes up by factors of 10 on the y-axis. We see here that value, if you held a basket of value stocks, a value index from 1927 to 2020, and you held a basket of growth stocks, value would be 51,000, whereas growth would be 2,000, almost 3,000. So we can see massive outperformance of value over time, and that's actually what the academic and real-world data suggests, is that over time, value outpaces growth in terms of market rate of return. This is important for us to remember as investors when we see these growth companies, that on average, growth companies will be slightly overvalued compared to value companies. But that's not to say an individual growth stock won't be properly valued. Like an Amazon has been very richly valued over time, but it hasn't been overvalued because it's really attained that rate of return that you would need for the future cash flows for that business. I have pulled up here the S&P 500 Value Fund. This is an index that the S&P Dow Jones Indices creates, and we're going to look here at the constituents, so what stocks are actually in the index right now and which are most heavily weighted. So as we can see here, the top 10, Berkshire Hathaway, United Health Group, Verizon Communications, Johnson & Johnson, Pfizer, AT&T, Walmart, Bank of America, Cisco Systems, and JP Morgan Chase. Let's take a look at the sector breakdown for you really quick. We have healthcare at 20%, financials 18%, consumer staples 11%, industrials 10%, communications 8%, information tech 8%, utilities 6, consumer discretionary 6, energy 4.5, and materials 3.2, and real estate 3.1. So we can see there's a massive weighting to healthcare, financials, and then consumer staples, industrials taking up the third and fourth spot respectively. So let's take a look at a few of these companies, just a brief overview to let you know the surprising quality of these value stocks given the current market conditions. So Berkshire Hathaway, let's look at that one. Berkey B. That's what I like to say when I look it up, Berkey B. Berkshire Hathaway B shares, just for everybody. I'm assuming not very many people are going to be buying the A shares that cost over 300 grand. I don't think a lot of people have that kind of money for one share of stock right now. So we're going to be looking at the B shares. They're the same, except the B shares have less voting rights. That's an important note. So we can see that it's a very good stock. It's owned by Warren Buffett, not owned by Warren. Well, it is owned by Warren Buffett, and it's operated by Warren Buffett. And he's the CEO along with Charlie Munger, his right-hand man. He's got a number of other great employees. We can see earnings have been relatively even over the past few years. No big hiccups. They have enough cash to cover all of their debts, and they trade at a pretty reasonable multiple. We're not going to be looking at the earnings multiple because the earnings multiple does consider their stock holdings, and that negatively and positively affects it. It basically just skews the results. We're going to be looking at the price to owner's earnings primarily, and that's at a 17. So that's pretty conservative given that this is one of the businesses that has been most resilient and grown at a fairly quick clip over time, and they own a massive stake in Apple. So if you think Apple is fairly valued, then the stock is very undervalued. Let's look at one of the other ones. Let's look at Johnson and Johnson. This will be an interesting one because this is different than the Berkshire Hathaway pick. This is a biotech type pharmaceutical company that has operations in very different areas than Berkshire Hathaway. So we see here that they're even at a PE ratio of 26. That doesn't exactly seem like value to me, but if they're growing, I guess it definitely could be. So Johnson & Johnson, this is an interesting pick considering the recent pandemic and just the fight against that. I'd encourage you on your own time to go take a look at a number of these other companies. There's some really high quality picks in the value index right now that you don't really want to pass up. So I'd go take a look at them. Look at the quality of these companies. You might be surprised. These aren't low quality businesses like they used to be. So thanks for watching. We're going to end this video here. It's getting a little long. I'm going to let you go do your own research. Please subscribe if you want to see more, and give me a like if you enjoyed the video. Thanks.